Good morning from our global headquarters in New York. I'm Manus with Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
Day two of unease in the global bond market as investors await the latest U.S. GDP and jobless data. And an AI letdown. Micron drags chip stocks lower after its forecast failed to meet lofty expectations. And Searchlight's Oliver Haarmann joins us later this hour on the looming maturity of debt. Good morning, Manus. Great to be back with you.
Danny, very good morning. Great to have you back with us. Is it time to turn around? Is it time to pause, rotate, and defend? That is the question that is coming into some people's minds. Piper Sanders say the engine warning lights are on. Now, look, you can hardly call a bit of a drop this morning in NVIDIA a serious warning light, but it's down 1.125%. Jensen Huang defends the moat at the AGM. Yes, see, Micron is where the pain trade is this morning. It drops not so much on the AI narrative in their results, but on good old-fashioned, let's say, traditional PC market. That's where the warning lights are there. UBS say it's time to right-size your tech exposure. So both those stocks taking a little bit of a chip, excuse the pun, out of the futures this morning. When it comes to the bond market, the 5-year auction did fine. The bid-to-cover ratio wasn't so bad, but it is still one standard deviation below the 1-year average. That is not indigestion. That's simply questioning where we are. Overall, we're back to flat. Yes, the global bond tail is wagging in Australia and in Japan. You've got hotter inflation in Japan on the expectations. But right now, we're counting down to the 7-year bond auction today, $44 billion and change. Dollar yen, it made that 38-year high for dollar, low for yen, reigniting the debate about when we will get a rate hike from Japan. Adam Posen was with us yesterday, Danny, talking about managing the decline of the yen and to fight back with rates. Use the rates and use that market, not throwing peanuts at the intervention gallery. Good morning, Danny.
Good morning, man. It's got to be honest, I'm really distracted by the bottom of the screen right now. Micron down 6% on an earnings that simply met forecasts instead of beating them. Perhaps it is a warning sign for these AI stocks where you've had very full positioning and a nervous market, maybe weaker hands. But this is the thing, as you mentioned, it's really only met forecasts because of its traditional business. About 2 quarters ago, the same exact set of results for Micron, where it was the PCs that disappointed and the stock sell off precipitously, and we forgot about it. And the AI rally ensued. So we'll see if we have that short-term memory yet again this time.
Yeah, but we were in an evangelist dream in terms of AI, 6 months ago, a year ago. There's a couple of notes have come into the box saying, is this an AI canary in the coal mine? They are meeting demand now. And this is what Sophie Lund said yesterday from Hargreaves Lansdown, which is, it is not the now that we're worried about, it's 2025. And as you said, when we sat down and we were debating the Micron situation, Danny was much more aggressive on the downside of the note that I have from Radio Free. But it was, the demand is there right now. It's what happens going into 2025. And there are serious doubts about that.
Right. To be fair, the only issue I had with what you were talking about was that someone called NVIDIA cheap. I just don't see how you can call it
very, very upset at 3 a.m. this morning.
It trades 48 times sales. I just don't see how anyone can call it cheap.
Year 2000, history rhymes. It doesn't necessarily repeat itself at times. It's good to have you back. Now I've got somebody to argue with.
No longer arguments with yourself. That's good. That's healthier.
I do that with the team in the break. Okay, good to have you back on set. Let's get back to basics because we're talking about investors and what they're expecting. It is about the latest GDP numbers, the jobless claims, the data, the new home inventories. They stood at the highest level in over a decade since the bursting of the housing bubble. Another market at risk that could drag on the U.S. economy in the second half of the year. This comes as the numbers for the GDP hit the tape at 8:30 a.m. Our guest this morning is Abigail Watt, U.S. Economist for UBS. Good to have you with us. You're also concerned about a slowdown going into the second half. What scale of slowdown, and does that play through to the disinflation narrative? Good morning, Abigail.
Good morning. Thank you so much for having me join today. Yeah, as you say, I think we're tracking currently for the first half of 2024. We're currently tracking that GDP will come in below 2%. And if we think about the kind of boomy kind of 3.1% growth that we saw in the US economy through 2023, we think that is a fairly marked slowing. And going into the second half of the year, we're also expecting the economy to continue to slow. We think that over the course of the year, the economy will expand below 1.5%. So we think this is a fair slowing. There's a couple of drivers there. The first is that we think consumption will begin to slow. We also think that fiscal stimulus was a big part of the story in 2023, and we think it will be less of a boost for growth through this year. And then finally, we think business investment will remain relatively subdued. In particular, we think that there's some scope that policy uncertainty around the election in the third quarter could hold back some investment from the business sector as well.
So, Abigail, I mean, there have been some Fed officials that have started to kind of sound like you. Mary Daly is perhaps one who said that, maybe Lisa Cook too. Yet, Michelle Bowman now for 2 days in a row has beat the hawkish drum. Yesterday she was speaking in London at a closed-door event and reiterated the line that it wasn't time to cut rates, that inflation was still a problem. Given you see a slowdown, are you concerned that Fed officials are setting their policy to yesterday's data and risk a policy mistake by not cutting soon enough?
Yeah, so it is interesting. We have heard kind of fairly mixed comments from various FOMC members since the June meeting. Generally, at the June press conference, Chair Powell reiterated the strength of the economy and the kind of strength of the labor market in particular. And one of the things that kind of surprised us about the June meeting was that some of the language in the statement didn't acknowledge some of the slowing that we've seen. You know, Q1 GDP came in at 1.3%. We're expecting that to revise up a touch to 1.4% in the data later today. But ultimately, we do think you are seeing that slowing, and it is a fair question, the extent to which that is kind of feeding into the narrative from the FOMC.
Well, one narrative that we're going to debate probably for the whole 60 minutes tomorrow morning when we go forward 24 hours is the debate between President Biden and former President Trump. Now, we had Adam Posen with us yesterday. He talked about the risk, the material risk of a shift of immigrants out of the country, anywhere between 1.3 to 7.5 million immigrants removed from the system over the next 3 years, and the prospect of much more aggressive tariff regime. We don't know what will be delivered. Tonight, we're going to hopefully get a little bit more intimation about where Trump stands on some of these things. But that prospect delivers stagflation, unabated stagflation. Is that a mounting worry for the UBS economics team?
Yeah, so in our economic outlook that we published last year in November, you know, we acknowledged, you know, the risks around the election. We see kind of three key areas of policy that, you know, we're watching closely. The first would be fiscal policy, the expiration of a great number of provisions for individual income tax policies, you know, expiring at the end of 2025. The second would be around that immigration element. You know, the increase in immigration through 2023 was a big part of the labor market rebalancing that we've seen, and the ability for us to continue to see kind of waning wage pressures and some of that kind of disinflation and that inflation progress through 2023. So obviously that's one of the other elements that we'll be looking out for. And then I think as well on tariffs, obviously that is another element of the policy that we'll be looking out for. And in particular, I guess, thinking about some of the possible kind of inflationary impacts and the impacts on the growth inflation mix in the US economy as a result of those.
Abigail, you put that all together, and it is a 2025 that is just wholly unknown. You look already what's happening around the world, inflation surprises from both Australia and Canada in just this week alone. Do you think that's instructive at all for thinking about 2025, that the threat of moving down in inflation, of getting rates back to normal, will have this bumpy road where we need to rethink things?
So our expectations on the inflation side are that we continue to see that inflation progress. I mean, we did see obviously a better inflation report on last week in May's CPI release. You know, the headline was certainly more encouraging. Obviously, the rent component of the index was still a little bit stickier than we'd perhaps like, but our expectation is that we do see progress on inflation continuing, and a big part of that is our expectation that we think the economy will continue to slow. And as we see that slowing and the continued kind of slowing in the labor market and the loosening in the labor market, we do think that that will lead to kind of core PC inflation coming in at around 2.1% by the end of 2025. So that's our base case assumption in terms of the outlook for inflation. Okay, Abigail, really appreciate your thoughts this morning. Great to get them. Abigail Watt,
of UBS. Okay, Manis, let's get to some of the other top stories that are trending on the terminal this morning. An era of big paychecks for China's financial elite is ending. The nation's largest financial conglomerates have asked senior staff to forgo deferred bonuses, and some employees are also being pressured to return excess pay from previous years.
SoftBank's Vision Fund 2 is investing in Perplexity AI. $3 billion valuation. The deal is Masayoshi Son's latest bet on the sector that he deems is crucial to securing his legacy. Perplexity, which is a US startup, has distinguished itself from other AI chatbots by providing more real-time information.
Shares of H&M getting crushed this morning. They are plunging. The fast fashion retailer reported disappointing earnings and a slump in June sales. New CEO Daniel Ever is under pressure to accelerate H&M's turnaround with intensifying competition from Zara owner Inditex and China's Shein. Manis, those shares down 13%.
Yeah, when will Shein come with their IPO? Coming up in the show, Micron extends its post-earnings decline after failing to meet those sky-high expectations. We look at the impact on the broader industry.
And later this hour, we're going to be speaking to Oliver Haarmann on his outlook for deals in the second half of the year here on Bloomberg Brief. You're watching Bloomberg Brief. Danny Berger and Manis Cranny in New York. Micron failed to meet Wall Street's sky-high expectations for the chip maker. The sell-off down more than 5.5%, but it did rally 67% this year heading into the earnings report. Investors had been expecting a bigger payoff from the AI mania that has swept markets. Joining us now is Bloomberg's Henry Wren. Henry, it is remarkable to see a stock punished for merely meeting expectations. So did we just run up too far in the preceding days and year into these earnings?
Yeah, indeed. As you pointed out, that the stock has already risen by 67% into earnings. So this post-earnings expectations has been probably too high. So the stock reaction is probably not totally unexpected. As we see, the company beat consensus estimates in terms of this quarter's sales guidance at the midpoint, but it fails to beat the most bullish estimates, and that has been seen as a letdown by the bulls. The point of weakness is probably doesn't come from the new demand, so AI data center, but most likely from the more traditional markets, so being PCs and smartphones.
So this is when the market really begins to worry about their capex. It's going to be in the mid 30% range if you've got the traditional business, which are the pillars that support the innovation. Is there any way, and Danny and I are at loggerheads over this, as to whether the Micron reading on AI can give us any kind of a broader read on the supply chain or on the state of play in AI? Certainly not if you listened to Jensen Huang yesterday at the AGM, but give us your take.
Yeah, indeed. So Micron's post-earnings reaction definitely serves as a cautionary tale for other AI chip stocks, which has probably run a bit too high in terms of the stock price, but as well as the analyst expectations. And that's exactly what we've been seeing in pre-market trading for now. NVIDIA has been trading lower, Qualcomm as well as NASDAQ futures. But in terms of the supply chain, it could be another story that we've been seeing. European chip equipment makers have been trading higher, especially for ASML, ASMI, and others in Europe. And these companies are the providers of cutting-edge chip equipment that are essential when it comes to making those memory chips, those high bandwidth memory that will go into the AI chip, AI computing for NVIDIA, for others. So these are the stocks to watch, and they have been trading higher in Europe.
Okay, well, let me play devil's advocate here, Henry. Couldn't I just say what we're seeing from Micron is simply about their PC business? It's a slowdown in its traditional core business, and it shouldn't have any impact for NVIDIA.
So for now, what actually we've been seeing is the traditional markets, including the PC and smartphones, they have been going through a painful downturn in 2023, and they have been stabilizing for now. But they are still, when it comes to recovery, that has been slow and that has been dragging the memory chip demand. But for the AI demand, that has still been showing no signs of slowdown. So in terms of the AI read across, in terms of the AI supply chain, that's still bullish signals, although that you can argue that they don't beat the most bullish expectations, but still that's ahead of expectations at the midpoint. So there's actually not so much bearish signals that you can read through if you are an NVIDIA investor.
Okay, well, we're on tenterhooks to see how the rest of the day goes, but certainly Micron is taking a bruising at the start of trade in the pre-market. Henry, thank you very much. Henry Wren on the very latest tech rumbles. Now, another company with lofty expectations, it's SpaceX's tender offer. It's said to value Elon Musk's company at a record $210 billion. Now, this is the world's second most valuable startup, and it was last valued at $180 billion. That was in December. The world has moved on. Matt Bloxham is with us. I mean, look, it's an Elon Musk company. It had a valuation the same as Verizon and General Electric. That was back in December. That valuation has increased. What has materially changed? Is it faith in Elon Musk, which I say probably is more questioned in the past 6 months, or is it the business model of SpaceX?
I think it's more the business model of SpaceX, to be honest. And I think, since that December valuation, the company's gone from strength to strength. That they have a number of strings to their bow. They've kind of got the launch business, and then they've got the Starlink satellite business. We've seen that the Starlink satellite business is hugely important, both from a kind of commercial perspective, but from a geopolitical perspective too. And the launch business is by far and away the leading launch business in the world, and they've got these incredibly good contracts with NASA, we've seen some of their competitors, fumble a bit. There's these ongoing issues with Boeing Starliner that's currently docked on the International Space Station. SpaceX's equivalent, Crew Dragon, has been going ahead, relatively smoothly, and obviously, as we're seeing on the screen, they're now moving into their Starship launches, which got off to a bit of a tricky start, but the last launch in June was pretty successful, and they're planning another one in July. So I think as a business, it's in a really strong position in the space segment, and I think people's interest in space is just growing over time.
What about its Starlink business, Matt? How has that been contributing to the revenue of SpaceX and its growth that we've seen with its valuation?
Yeah, it's a good question. Obviously, the amount of information we actually get about the revenue mix is limited. Certainly, we're hearing lots of kind of encouraging noises from SpaceX itself and from the industry about adoption of Starlink, and certainly in terms of kind of forward projection. I mean, I think in rough terms, I think people think SpaceX generated about $9 billion of revenue last year. A few billion of that coming from the launch business. I think going forward, the current expectations suggesting around $15 billion of revenue for SpaceX in 2024, with most of that growth coming from the Starlink business. And certainly Elon Musk, when he talks about the future growth opportunity for SpaceX, he definitely puts the emphasis on that Starlink business as being the big growth engine. Clearly they can grow more in the launch business, but there's a clearer cap on how much more they can get out of the launch business. So Starlink is really central to the mid to long-term growth expectations for this company.
Matt, thank you so much for that. That is Bloomberg Intelligence's Matt Bloxham. Okay, coming up, your Rolexes may be getting pricier. Manus is currently checking his watch to see how
it's not a Rolex.
We're gonna have
it's vintage, but it's not a Rolex.
We'll have more on.
It's like me, vintage.
Get out of here. We'll have more on not Manus's watch, but Rolexes.
It's Bloomberg Brief. It's a bit of a shock. She's Danny Berger, and I'm Manus Krenny. Reunited. Let's get you up to speed with your front pages. This is what we've got for you that are making headlines around the world. The FT, we lead with that. The French far-right leader, Jordan Bardella, vows a cultural battle against Islamicism. Also demands that the EU budget rebate. He says that he's confident of winning an outright majority in the legislative elections.
Which, of course, would lead to cohabitation. Next up on the AP.
That's us.
That's us, yeah, cohabitating. Trump and Biden are going to be facing off for the first time since the 2020 debate. You have the situation, Manus, where both candidates are trying to shape the narrative, get ahead of this. I love this. Anne-Marie sent this along. Most viewers, per a CBS poll, want to learn about plans and policies. Good luck to them.
I mean, that kind of frightens me that, you know, there's a belief that watching these debates, you're really going to get an insight into policy. It's a favorite theme of our viewers. We know that. You just need to go to sorry, not Richgo. You need to go to Poshco on your terminal, and you find out what Rolexes are for sale. But the top-selling Rolex seller in the UK says there is pressure, although things have settled a little bit, is what they would say. We're talking, of course, about watches of Switzerland, and there's the famous Pepsi. Now, the question is, Danny, do you want a Pepsi or do you want a Batman?
So if I care about
She cares.
money, then you want a Pepsi. You want a Pepsi because, as Manus flagged to me this morning, Pepsi's actually been gaining in value, while the Batman, which was that other black and blue one, has been falling in value.
Yeah, your Pepsi's up by 4%, your Batman is down by 10%, and if you're vintage like me, you go for something else and something a little bit more subtle.
Well, here's the bad news. Because the price of gold has been going up with the rally we've seen lately, Rolex has actually hiked their prices, only by 4% in the UK, but it's something. So
still, the monster part of their business for Watches of Switzerland is the second-hand market, and that's where you go on the list. You've got to have spent a certain amount of money in a Rolex shop before they will actually allow.
Are you speaking of from experience?
Let's put it this way. I'm not on the list. Let's just put it that way. I'm vicariously living on other people's lists in Rolex shops around the world.
But Rolexes are out anyway, so you don't need one. It's cool to have like a plastic swatch or something.
Vintage is in.
Vintage
We'll be back.
You heard it here first. From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
It's day 2 of the unease in the global bond market. Investors await the latest US GDP and jobless claims data. An AI letdown. Micron drags chip stocks lower after its forecast failed to meet those lofty expectations. And Searchlight's Oliver Haarmann joins us around the desk. We talk looming maturity wall of debt.
Before we get to that, Manus, let's quickly whip through these markets because it is a market shaken a little bit by Micron. S&P 500 futures down 0.1%. Micron merely meets expectations. And for this market, that is enough to punish it, down more than 6% in the pre-market trade. But can it bounce back? JP Morgan says take any opportunity of weakness to buy the dip. U.S. 10-year yields little changed, maybe slightly higher. It has been a global bond sell-off kicked off by hotter CPI in both Australia and Canada. Meanwhile, the dollar-yen, that starts to recover. Yen stronger versus the dollar by 0.2%. It had been around 161. We go down to 160 after reaching its weakest level versus the euro on record and the weakest level versus the dollar in over 30 years. Manus.
Yeah, and that is about managing the decline, according to Adam Posen. And that was an interesting conversation yesterday. Instead of throwing peanuts at the defense gallery of intervention, use your rates market. But on the Micron, just sort of reflecting on what we chatted about through this morning, the Micron piece is probably a little bit more ominous for the traditional set of chip producers out there, because it is their traditional business. I know we have this angst between the two of us about what it means for AI. It's good to have angst on a show at 5:30 a.m.
That's the market.
That's what makes a bid and an offer.
Yeah, exactly.
I'm offered all the way.
I don't know. I just think it shows that
She still bid.
But I do think it shows that there are some weak hands in this market. The fact that these stocks can sell off so easily.
Yep. Well, let's see how it plays out for the rest of the day.
Well, from public markets to private markets, let's turn there where Searchlight Capital founding partner Oliver Haarmann is saying that staying optimistic that the market will pick back up after years of slower deals. Yet there is something else that could create opportunity. He says we anticipate the greatest source of deals in the market coming from when the wall of debt maturities comes due. Oliver joins us now. Oliver, thank you so much for coming in the studio. It is great to see you this morning.
Thank you. Good morning.
So I know you see a lot of opportunities coming from this maturity wall, but I want to know about the other side of things. For those that need to refinance into higher rates, talk about the scale of distress and trouble that is potentially brewing for those companies.
Well, I mean, potentially there's hundreds of billions of debt that's coming up for refinancing over the next 3 years. A lot of that is, we know there were so many acquisitions made in the 2017, 18, 19 period, at high valuation levels, but also very low interest rates. So people really were able to take on a lot of leverage to drive equity returns. And of course, it always feels scary when you're sitting as an equity holder and there's a lot of debt coming due, and you say, wow, maybe I bought this company for 10 times EBITDA, and maybe I borrowed 6 times EBITDA to fund it and put in 4 times of equity. And now I can only afford to borrow 4 times. So it's kind of scary. What do you do? I think that's related to the corporate world, but also to people's personal lives, whether it's a credit card debt or a mortgage.
So true. Okay, so when we get to that point, right, and everyone's dealing with this kind of scary atmosphere, we've been talking a lot about how the idea of there's this mismatch between buyers and sellers, that buyers want something lower, sellers aren't willing to sell at those levels. Yeah. Is this what brings the gap down?
It does help bring it down a little bit because you have to act. So if you're staring at that example that I just gave, and you can only afford to maybe borrow 4 times, what are you going to do? You're going to have to take action. And either you're going to sell assets. So, we are starting to see some deals where companies are selling assets, and they use the proceeds to reduce their debt, and then they can refinance the remainder. Or you raise equity. Obviously, you can always raise equity through an IPO. We know that's challenging. So there's other equity offerings that are possible, which we can talk about. And last, there's also going to drive some mergers because it might make sense to merge with a competitor, take the combined synergies of the combined company, and then refinance the combined debt at a more attractive basis.
Well, what is gaining traction at the moment? And I'm going to bring you some headlines from the Bank of England. We can talk about these. These are literally just crossing the Bloomberg terminal as we speak right now, which is that more private equities are struggling. The Bank of England warns that private equity exposed to tighter financing, as Danny has said. So, again, this is their report that they produced. They talk about the stability report. It's the financial stability report. Would you agree that we are in a struggling mode and that we may see some king's crowns fall in that struggle? Are we going to see some?
Yeah, each deal is individual, right? So each firm is going to have deals falling into lots of different categories. And of course, there's the companies who are struggling to refinance their debt because they're underperforming their initial business plan. And those companies will have a harder time. They will obviously have to restructure, and the underlying equity owners will probably have to take some form of a haircut.
Right.
We've actually done some really interesting deals recently in good businesses that are still facing the refinancing wall because they need cash flow to reinvest in their business to grow. So in that example that I gave, you might be able to actually refinance at 6, be able to afford refinancing at 6 times, but you don't want to because your business is growing and you want to reinvest your cash flow in the business. And those can be really interesting opportunities where you're helping a business right-size its capital structure and effectively maintain the flexibility to keep growing, either organically or through M&A.
I mean, it is interesting, this kind of confluence of factors, because on one hand, you have maybe some companies that are exposed to these tighter financial conditions and are kind of struggling, yet there is a lot of money in private debt right now chasing assets. And you get this weird thing happening where some of these companies are doing strange restructurings. Vista Partners was one of them that did it recently. And still money is willing to be put to go to work. So with a lot of money and a deteriorating kind of atmosphere, do you see sort of bad behaviors picking up, this lender-on-lender violence, or maybe more risky things, taking out more leverage? Is it sort of fueling some of the risk-taking that maybe shouldn't be happening?
Well, I'm not sure it's risk-taking, but people will certainly get creative in terms of how they can capitalize their businesses. And there's going to be ways of doing it, within the existing credit stack, and coming up with clever ways to potentially put more capital into the balance sheet that actually might be less favorable to existing lenders. There's always going to be smart lawyers and private equity technicians who figure out interesting loopholes to create more capital.
But again, just to drive home the point, I wonder within that if that's a troubling turn, that you're starting to see these lenders pushing people down the capital stack and willing to go above them. And again, this sort of lender-on-lender violence, as it's called.
Yeah, I think, look, it's a market. I think it's a clear market. The market clears at certain places. I think there will be some behavior that's challenged in courts. But there's also some of it that's just an evolution of the markets, and people adjust and adapt. And future credit agreements will be amended to adjust those things. I want to come back to a big opportunity that we're seeing, which is really in preferred equity. So one of the interesting things that we've been doing is in these growth companies, let's say they do have 6 turns of debt, can only afford 4, we've been putting in 2 turns of preferred equity. We think those are really interesting risk-adjusted securities because on the one hand, the company is right-sized. It has a more affordable stack of debt. and it continue to grow. And we get a very nice low to mid-teens type core return on our preferred equity. Plus, we have usually some equity upside through warrants, options, other abilities to participate in future upside. And we're downside protected because we only have 4 turns of debt above us.
So you're protected all the way. But what about the investors which are looking for exits and they're simply not there at the moment? I just wondered, is that imaginative structure of financing that you're creating and putting in there, which keeps the businesses alive, but does it extend the IPO much further into the long grass? The traditional exit, is that what you're doing? You're giving yourself time and breathing space to face a better market in a better day.
Exactly. That's definitely true. We are starting to see, obviously the IPO market has been driven by just sexy mega cap, large tech opportunities, right? Which is not applicable to most businesses. We have started to see trade buyers, strategic buyers start to come back. So we have over the last 6 months have actually had interesting approaches from strategic buyers for our assets. I think they often might be smelling an opportunity that private equity is motivated to sell, and maybe there's a deal to be struck.
Are you motivated to sell? Are these bids? Where are these bids coming through? Which sectors?
Well, we recently struck one with a trade buyer last fall that was a good, very strong, 2.5 times return for us in little over 2 years. So some of these are good, attractive returns that you're generating, especially if the strategic buyer thinks you have an attractive asset that's going to enhance their business and create synergy value for them, so they can afford to pay you. So we're not taking discounts on these deals.
Right.
But you have to own good assets. It all comes down to owning, good businesses at the end of the day.
Just quickly, Oliver, I mean, and this sort of applies to what Manus is talking about there being a lack of IPOs and only the sexy mega cap companies, as you say, are getting bids. Is a lot of this market underloved and prime for you to come into public markets to take private?
Yes. Take privates have been a massive opportunity for us as a firm, but I think for private equity more broadly. We've done, just in the last 9 months, we've completed 2 in the UK and we have 1 underway in the US. There's a lot of companies with less than, call it, 3-4 billion of market cap that are just ignored by the market. There's not enough institutional interest in them. Then the banks stop writing research. Then there's even less interest. The shares are very illiquid. And if you come in with a nice premium, it can be very attractive to the board, to the shareholders, and frankly, the management. Management often feels in those businesses they'd actually rather be driven by private equity ownership because, we take a 5-year view. We have a clear strategy. They talk to one set of investors.
You're giving out equity to the employees. There's a few other people. But is that a big part of it?
Yes, there's compensation benefits to it, and also less disclosure on the compensation, which is a positive thing in some instances.
You want to tell us who you're looking at?
Oh, I can't talk about that. I can't talk about that.
I thought we'd just go in for the last kind of...
Yeah, no, I can't do that.
Fair enough.
No, I would get in a lot of trouble if I did that.
Okay, well, we'll put you out of your misery. Oliver, thank you so much for joining. We really appreciate your time this morning. That is Oliver Haarmann of Searchlight Capital Partners. Okay, let's stick with private equity and credit specifically for a while longer. I spoke with Carlyle's Mark Jenkins and Goldman's Christina Minnis on how they're navigating through various macro risks and how that impacts their investment strategies. Take a listen to our conversation at the Bloomberg Invest Conference.
34 years ago, I didn't pay any attention to it. I mean, I think 34 years ago, you focused on the micro level. I think after the great financial crisis, we said, wow, we should focus on macro and micro. And I think after we came out of the pandemic, the Russian invasion of the Ukraine, we said, geez, geopolitics is actually pretty important. And, just to give you an example, if you look at container shipments today, all right, with the the conflict in the Middle East, if you will, what's basically happening is the Houthis are basically shutting down that area, which accounts for 15% of global trade. 80% of shipments that went through the Suez Canal are re-diverting. It's adding an extra 15 days to deliveries, and you can figure out what that cost is. So we came out of this very global environment, which we realized how fragile it was through the pandemic, and that it was overly complicated by global conflict, right? Like another great example is, if you remember in the Ukraine, when Russia first invaded, basically there were these clips, plastic clips that were made that were to hold together in the automotive process wires. And guess what? They're probably cheaper to make in the Ukraine than they were in Germany. And so that's where all of them were made. And once they stopped being made, guess what? You need that clip, you can't make a car. And that just showed how fragile the environment was.
And Christina's just continued. Now we have to deal with political volatility in France. That has had quite the impact on bond markets. So how much does it come across your desk day to day?
You know, it's interesting. It's much more acute than it ever was. When the situation in France evolved, in the last week or so, the markets reacted very aggressively. Now the markets have settled down here in the U.S., but talking to my colleagues in London, any company that has exposure right now in France is very concerned, right? And so, I think we would never have paid much attention to the French elections, but now we're paying close attention. And so I think it's just one more element of volatility we have to pay attention to. And to Mark's point, we recently underwrote a situation where 40% of the company's production came basically out of China. And 5 years ago, we would have thought about it. We would have thought about the risks and probably moved forward. That's a pretty significant risk issue to handle, and how you price that and how you're going to package that for investors. So it's 100% front and center in a way that it hasn't been.
That was Carlyle's Mark Jenkins and Goldman's Christina Minnis speaking to me at the Bloomberg Invest Conference. We'll have more on the world of finance coming up here on Bloomberg Brief.
It's Bloomberg Brief. I'm Menace Rennie alongside Danny Berger here in New York. Jefferies' profits soared in the second quarter. The investment banking revenue momentum continued. Debt underwriting more than doubled. President Brian Friedman said this: "We are well beyond the green shoots, and we would suggest a broader recovery in capital markets activity, and M&A is underway." Ring a bell. Sonali Basak, day 3. She's recovered from Bloomberg Invest in New York. Great two-day gathering. So well done to you.
Thank you.
And the whole team. Danny and I were there for parts of it. We've just seen Danny. But talk to us about Jefferies. I mean, this is like, come on, second half, bring in the bonus time at Jefferies.
And Rich Handler is saying second half of 2024, second half of 2025, a lot of optimism. I've got to say, speaking of Bloomberg Invest, very interestingly, a lot of people don't feel the same way. PJT's Paul Taubman said people might wait until next year until they do larger deals. The reason you might see a different tone over at Jefferies is because that leaning into private equity sponsors in a much bigger way, and also to kind of mid-sized deals. Importantly, a lot of the drive higher in investment banking fees came from underwriting, which is also more particular to Jefferies than it would be to a lot of more pure play M&A focused advisory. Of course, debt markets have been booming with the anticipation of at least one interest rate cut. And so you're seeing that feed through the underwriting results in particular. And we'll see for M&A, but they are certainly optimistic.
So we have a couple different banking threads to pick apart, Sonali. Another one of them is UBS. The team at Bloomberg, they obtained a memo basically saying we're reorganizing our wealth division. What are they doing?
Well, a couple things. One thing that's really interesting is they're bringing over Michael Camacho from JP Morgan, longtime leader in their asset management business, a longtime leader in commodities businesses over at JP Morgan. And so they're bringing in fresh talent in addition to what they saw over from the Credit Suisse deal that they're elevating people from as well. Remember, this is only roughly a month after they really elevated and created a new leadership structure around Rob Karofsky, who is a longtime Deutsche Bank and Morgan Stanley executive before joining UBS. And since joining UBS has only been rising, he and Iqbal Khan are in the succession plan when you think about Sergio Armati. And their plan here, Rob Karofsky now leads the U.S. business, Iqbal Khan moving over to Asia, is to build up that wealth management business so they can invest more, also client assets and alternatives, the hot moment of the day, of course, and lend to those wealthy individuals more. Listen, UBS has been pushing into this world even harder for a very long time to try to really serve those wealthy clients in different ways. But I've got to say, what's interesting about this restructure at this time, or this reorganization, is that it comes at a time where you also have Goldman Sachs, Morgan Stanley doubling down on alternatives for their clients too. And so it meets the need of the moment.
So we had financial stress tests, and I think JP Morgan's line was, this is better than we even thought it was going to be. I mean, this is about how you run your business, how much capital you need to run your business. Speaking of UBS, of course, they're under a lot of pressure from their regulator to add more capital. That's the risk for them. And here we are in America. This playing field is becoming again, and this is going back to Armati. Armati, for the past 15 years, has basically said this playing field is not even, and here we are. is the good old USA tipping the scales again in terms of the stress tests and capital.
And says the bank that if you look at the Federal Reserve's chart here, Deutsche Bank and UBS, actually in the divisions that they have here, the drop in CET1 was actually much more severe than you saw at the big U.S. banks for their U.S. division. So when you look at the U.S. divisions, what was interesting here, yes, of course they all passed with flying colors, but the drop in the CET1 ratio was more than before. And that comes at a time where they're looking at the Basel III endgame, thinking about those capital requirements. And so a lot of concerns under the surface, questions about payouts as well, given some of these banks, Goldman, Morgan Stanley, the drop was above the median.
Sonali, thank you so much for coming in after a busy 2 days for you. Sonali Basak, who leads our finance coverage. Okay, another stock that we are watching this morning, it is Nike. Apparel giant is set to report earnings after the market closed. For more, let's get over to Bloomberg's Dasha Afanasieva, who joins us. Dasha, it's been kind of a confused picture for the retail and consumer-facing companies. For every weakness in an H&M, there's a pool that also says things are weak, but then, there's a FedEx where results are strong. It is confused. So what kind of clarity can Nike give us?
I agree with that. Yes, it's absolutely confused, and it's these kind of legacy players that, like Nike, that maybe looked relatively really good because they were constantly compared to Adidas, which was doing so poorly, and now that Adidas is stepping up its game, Nike is under pressure, and then there are these other competitors like On and Hoka. And I think now the chief executive, John Donahoe, is really under pressure to explain how is he going to bring back growth, to bring back top-line sales growth. So investors are looking for new product launches, for new strategies, for more cost-cutting. They've already been cutting some jobs in some of its offices, and I think people are expecting more detail on that. There's also a demand for some more detail on its China push. Bloomberg reported earlier that it's looking to sell things like cashmere ponchos and lambskin bras and $1,000 Air Jordans in China, because that's a very competitive market that historically has sometimes shunned Western brands, and that market is really important to fight for.
Yeah, well, certainly the $1,000 sneakers in China, it's going to be a question as to whether that's really going to drive them back to that 20% of their overall revenue coming from China. It's dropped significantly. Dasha, thank you so much for being with us this morning on the Nike story. Coming up on this show, it is the first presidential debate between President Biden and former President Trump. We'll debate that context on Bloomberg.
Let's get you set up for your trading day on this Thursday. U.S. GDP and initial jobless claims will come at 8:30 a.m. Eastern. And then we've got another bond auction. The Treasury is going to be selling $44 billion worth of 7-year notes at 1 p.m. Then President Biden and former President Trump face off in their first presidential debate. That's at 9 p.m. Manis, I'm really interested to see how this works with the mics being muted, no live studio audience. It should be interesting, to say the least.
Let's see if there's any fireworks. And, of course, we've seen a couple of different previews on that. The audience hoping to get some direction on policy. Some stocks to watch. Micron, we've touched on it several times. Extending the drop. The forecast missing the lofty expectations on the traditional side of the business, not so much on the AI. Levi reported sales that slightly missed expectations. Profit beat expectations, but the company reaffirmed its full-year guidance. The stock down 14%. WBA up 2.5%. Walgreens earnings before the bell. Consumer spending will be in focus. But, of course, it is all about tech, Danny, and the flow of money. And we've got something nice from Goldman's on that.
That's right. Goldman just out with this, that hedge funds have been aggressively selling tech. They sold the most in this month on record going back to data since 2017. So the momentum feels like it's starting to turn now, Manis.
Yeah, but the weighting of tech has been like at a really historical high. Fast money, sharp money goes to the gate first.